It's Fed Day, and it was a very volatile Fed Day, but you know why you're here. You want that market analysis, and we're going to give it. The market started from the first dot plot, from the first reports, rallying relatively strongly, then selling off moderately strongly, then coming back, then ending the day relatively flat, we'll call it. Initially, we see, okay, he's doing cuts, they're doing cuts, they're giving us a decent amount of cuts. This is not a Fed that is just doing 25 today and then saying, oh, we're not going to cut the rest of the year, or oh, we're skeptical on cutting the rest of the year. No, there was a number of people on the Fed that want to cut multiple times the rest of the year. There's going to be another cut this year, at least one, probably two, and that was relatively bullish. But unfortunately, to some, and in some ways of looking at it, that was only short-term bullish. If you ask me, the biggest thing in today's Fed meeting was the long-term rate on the dot plot. This was borderline seismic. I mean, 1% versus where I think it is or should be isn't something I would say is necessarily seismic really, but it was, in my opinion, the big takeaway. And that's why you probably saw the 10-year interest rate actually go up today. Believe it or not, the 10-year interest rate went up. It went up today. So what am I talking about here? The 10-year interest rate, the median rate is around 3%. Now there's a number below and there's a number above that 3%. But we'll call it, that estimate, around 3% long run interest rate. That is different from where we were pre-COVID. Pre-COVID, we were less than 2% on the Fed funds rate. They're trying to hit a 2% inflation target. So you have a 2% inflation target and you have a 3% interest rate, you're going to have a 4% or something 10-year, because the 3% is going to be the minimum rate. That's where you're going to get US dollars for parking your money at the Fed. Then you got, 3 months, 6 month, 1 year, 2 year, 5 year, 10 year, etc. The 10 year is going to be higher than all those rates. And that's going to impact certain areas of the economy. So we're going to see come down in the shorter end of the interest rate curve. But the longer run, if you saw what happened with the 10-year today, that's what it is. That's what it is. I think that's going very much under the radar today. That the higher interest rate, we haven't had, excuse me, a long run interest rate at this level in some time. So this goes pre-global financial crisis era. This is a new ball game, and valuations are quite high. Now, we're not going to really talk about what I think the stock market's going to do. We're going to keep things focused on the economy. But basically, I think the long run interest rate, whether for better or worse, is going to stay relatively high. I don't think we're going to see much improvement on the 10-year unless that dot plot changes. I think the Fed's going to cut a few more times, but I don't think they're going to cut below 3%, or at least it's not looking like that. That's going to be quite a while before we get to that point. And I don't think we're going to see much movement in the 10-year. So there's been a lot of thinking and a lot of people thinking that the interest rate's going to come down. And for example, that's going to be very good for real estate, that we're going to see this price appreciation for real estate simply based on the fact that interest rates are coming down. It appears to me that is not the case. So if you own real estate, or if you're thinking about investing in real estate, I would not expect prices to change solely based on the interest rate. That is obviously something that many people have been thinking would happen. I probably thought that would happen, although that's not my focus area. But it now looks like the long run Fed funds rate is 3%. And that means the long run interest rate, the 10-year, is going to be somewhere around 4%, which is where it's at. So we're not going to see much improvement there. That means interest rate benefit to stocks is not going to be that much either, because stocks are also long-term investments. Now, there are still areas of the economy that are going to benefit from the Fed funds rate coming down, things that are shorter term. For example, some shorter term auto loans will probably benefit somewhat. I would expect autos to maybe improve a little bit as that interest rate comes down. But, it's not so glamorous on the interest rate front. Now, that's only one side of the equation, okay? That is my Fed breakdown. Let's talk about the rest of the economy here, what Powell said about the economy, because there's plenty of things to consider here. We know what the interest rate situation is. The dot plot is about the best we can use at this point. It is a projection. It is subject to change. It could certainly come in lower than that 3%, but there was a wide dispersion. There were a lot above. There were some below. There was a lot below. It was pretty even, right around that 3%. That's what I interpreted it as, 3%. And one last thing. There's reason why they want to do that, why they want to keep it higher. In the event that there is some sort of economic downturn, it gives the Fed firepower to stimulate the economy. They can go, in the event of a bad situation, below that 3% level and stimulate borrowing. So there is reason to do it. I understand it. And honestly, I'm not saying the economy is going to weaken because the interest rate's going to be, the long run rate's 3%. That's not what I think. So let's get into the economy. So we've heard a lot about the labor market weakening. Powell's obviously trying to balance this stuff. But he talked about a lower participation rate. A lower participation rate. There's also a massive, deportation, people leaving the country situation going on. For the first time in decades, we've been having net negative migration. So you combine that with the fact that there's this massive baby boomer generation that is entering retirement age. I think you have two forces that are going to decrease the labor force participation rate, and the economy is still doing well. The Atlanta Fed saying over 3% is their current projection. The Fed increased their projections of economic growth. Powell repeatedly talked about how he thinks the economy is going to be strong, but there are signs of labor market weakness. I would not, at this time, read too much into the labor market weakness without an economic component or meaningfully larger and consistent layoffs from here. We've obviously seen some sporadic layoffs in the few thousand numbers. That seems like normal economic behavior to me. And we might be, we're still exiting. We kind of had a little bit of a delusional, really low interest rate printed money period going on. We're, in a more normal period, and we're actually doing well in this normal period. So I would not look into the labor market thing very much. I would assume the U.S. economy stays relatively strong. I think the tariff benefit is yet to come in full force. I do think that there's going to be, and there are already, I've talked to some people locally that are at the Samsung factory, for example, that are working here. And they're coming here from Louisiana, and they're spending money. They have good jobs. And I think this is something that is going to occur throughout the country and is going to continue. So I think the economy is going to stay strong. I think wages are going to be strong. I think wages are going to continue to go up. And I don't think inflation is going to go up. I think inflation is going to stay in check. Now, why would I think that? Why didn't wages going up previously mean that we had inflation? Well, in the pre-COVID period, we had tremendous wage growth. We had a tremendously strong economy, possibly the best two of all time. And we had very little to no inflation. So that is the paradigm that I know the Fed is trying to get back to. Powell hasn't talked about that since Trump's been president, but he was talking about that before, that he wanted to get back to the pre-COVID economy. And I think we can get there, albeit at a higher long-term interest rate, I guess. So we didn't have inflation in that period. Now, Trump has the ability to, if a good begins to rise in price and we don't have the domestic capacity to produce it in the realistically medium future, he has the ability to reduce the tariff on a good and increase it elsewhere to get the trade balance, set up. So I'm not concerned about the inflation. If the price of some random good goes up significantly and we need to increase imports, we can reduce the tariff and we can increase imports of that good. That, I think, I'm not sure that we're going to need to do that, but that is a lever that President Trump has, and he is very creative with pulling his levers. So I'm not concerned about the inflation. Full stop. I'm bullish on the economy, but when it comes to the Fed and it comes to interest rates, it's very notable, in my opinion, that the long run rate is 3%. that means the 10-year is not going to change that much. To me, it looks like it's not going to change much. And as a matter of fact, it closed the day higher. Closed the day higher from yesterday, closed the day higher from before the Fed came out, and that's just what it was. So that is my biggest takeaway of the day. Sure, it's great that we're going to get 2 more possibly 25 basis point cuts this year, but the big thing is the 3% interest rate. There is reason for that. Ultimately, I think the economy is strong and is going to stay strong, but if you were making moves based on that 10-year coming down, take a second look. That's what I got. That's what I would say. So that's today's video. DMs are open. Comments are open. If you have any questions, please let me know. I'm going to be getting a better tripod. I'm going to be getting a better phone. I got the 17 Pro, so the camera quality is going up. And I got a wireless mic. So thank you for watching the video to this point. I'm going to make them better. That's today's video, and until next time, peace out.